Awesome. We use structure to find a directional bias. We then even defined what that structure is to us. Point of interest as well. We use structure to find that point of interest. We then defined what our structure is to us. Lower time frame, we use those chart patterns and as well as that candlestick confirmation. We've defined all of that stuff for us. Now, excuse me. Let's do this and go down to here. Now, after we've done our process of analysis, right, we've defined literally the whole process of analysis. So this is now to say that when we are trading, this is where we find our information. These are the 3 timeframes that we're looking for information from. And obviously, we're going to use these 3 timeframes for these specific purposes. Now we need to say, go as far as to define what are these timeframes. For me, what is the highest time frame? What is my middle time frame? What is my lowest time frame? And now this definition, when you are defining this part of your process, this goes back to you understanding basically knowing yourself and as well as your goals, because both of these things are going to influence what type of a trader you are. First of all, maybe you've got a nice big goal, a nice big goal. You've got a nice big goal, but you've got a nice big goal as a swing trader with a little bit of capital, and your big goal has a short time period in which you're looking to achieve this big goal. Can you see just in that, just I'm sure just by telling you guys, you can see how much resistance is involved in defining or creating a process that just doesn't gel, first of all, with you, who you are, and what are you expecting to do with this process? Where is this process, where are you expecting this process to take you? If all of that doesn't gel, then there's going to be a lot of resistance in you actually executing the process that you've defined for yourself. So best advice, guys, as we're creating this process, try as hard as possible that later on, when you're defining the process for yourself, try as hard as possible not to copy paste. Try as hard as possible to try and just, yes, use the same structure, but the specifics, try and change the specifics to accommodate who you are and the goals that you've got. So nonetheless, let's define our higher time frame. And I'm obviously going to be referencing, like I have been throughout this whole thing, every time when we are specific to say, this is what we are using and this is what we are doing, I'm referencing my own trading processes. So I'm going to say for myself that for me, there are kind of 2 types of analysis, right? There's analysis that I'm going to be doing on the weekend. And then there's analysis that I'm going to be doing while we're trading during the trading week. So during the trading week. Now, over the weekend, the analysis that I do on the weekend is not the same analysis that I do over the trading week, because the timeframes that I use are different. So for these 2 types of analysis, I'm going to further define and say that I'm not going to call them week and trading week. I'm going to call these 2 types of analysis for me long-term analysis, because this is my weekend perspective, my long-term perspective on where I want to trade next week. How do I even filter my pairs out and create a watch list and all of that nice good stuff? This is from my long-term analysis. You guys will see how this, just by defining these things, you'll define so many different other elements in your trading process. And then obviously, after we've done that long-term analysis, we've got now our short-term analysis. So these 2 types of analysis are going to be slightly different just because of one specific reason. Or rather, let's just say 2 reasons. First reason is that the timeframes that we are going to use for long-term analysis and short-term analysis are going to be different. And in addition, long-term analysis has no purpose. Lower timeframes, they don't have a purpose on us doing our long-term outlook, because long-term outlook is us planning. It's more so planning. So there's no purpose in us going down onto the lower time frames, unless maybe the lower time frame is already in a point of interest where we're looking to take that entry. Then maybe the lower time frame has a function in our long-term perspective in the market. But nonetheless, let's now say for ourselves, for our long-term perspective, we're doing this analysis over the weekend. So we kind of the purpose of us doing this analysis is to prepare for next week. So we're preparing on everything that we've defined for ourselves. Remember, we've narrowed down our focus. We've defined the instruments, the markets that we're trading, whether we're trading indices, currencies, whatever those things are. We've also defined the individual instruments that we are trading. So nonetheless, you guys can see that my instruments have been the same throughout the whole year. AC, AF, AJ, AU, FJ, NC, NJ, UZ, and US30. Done and dusted. Indices and currencies only. So defining those things for yourself, obviously now when you're doing your long-term perspective, it's a lot more easier because how I used to trade last year, I used to analyze all 28 pairs and do the things to be done with a watch list. And obviously that took a lot more time, a hell of a lot more time. If you guys remember last year's Saturday sessions, we could go for like 2 hours on a Saturday session, but nonetheless, it took a lot more time than obviously right now after we've defined our things. So kind of we want to obviously isolate a watch list and do all of these things. So long-term perspective, guys, involves us on our higher time frame. We're going to say for ourselves, our high time frame maybe can be the daily, because the daily is kind of high enough for us to find a good directional bias off on our long-term perspective. And then as well as we only need to use these two time frames for our long-term perspective, the high time frame and the middle time frame. So we're going to just define those processes and say that over the weekend, these are the timeframes that I use. I use the daily and the H4 to find a directional bias and a point of interest. Now, also remember that while I'm finding a directional bias and a point of interest on these timeframes, I'm indirectly or directly or whatever the case is, I'm also making sense and understanding the information that I have on the chart because I'm using structure. I'm saying that, okay, my daily structure is looking like this. This is how I want to sell this pair. Okay, cool. My 4 hours looking like this. So based off my directional bias from the daily, this is where I can find an entry to be able to sell this pair. So now I'm 100% prepared. What I can then do is I can use this process of doing a long-term analysis to isolate a watch list. Now I can say that any pair that has given me a nice directional bias and maybe is closer to my point of interest where I want to trade that pair comes higher on the priority of my watch list. Any pair that is maybe far from my point of interest in terms of actually giving me an entry can be lower down on the watch list. So what you're even doing for yourself is during your trading week, you've already narrowed down your focus even further to say that, yes, I'm going to look at every single pair on my watch list, but I'm going to focus most of my attention, most of my energy on the pairs that are going to require me to make a decision rather than the pairs that are not going to require me to make a decision immediately during the week. And I'm sure you guys can see that, like maybe on Saturday when we're doing our long-term analysis, okay, cool. We always analyze most of the pairs, maybe excluding US30 most of the times because US30 is just uninteresting to me. So maybe excluding US30 some of the times, but we look at every single pair on the watch list. But you'll find that on Monday when we're doing analysis, maybe we're only analyzing AUD CAD, AUD USD, and NZD CAD. Why? Because only those three pairs are relevant for our focus and attention and time and whatever the case is for the day. Yes, every single pair is going to give us a setup eventually at some point in time, but not each of these pairs require the same amount of attention and focus and whatever the case is. So that's what we're doing by our long-term perspective, kind of also filtering out a watch list. Now, for our short-term perspective, now we're going to say that when we're doing our short-term perspective, now only do we add our lowest time frame. So we're going to change things. We already said that for our long-term perspective, these are the two time frames that we use. For our short-term perspective, we need all three time frames, a high time frame, a middle time frame, and a low time frame. Now, the only adjustment that we are going to make when we're doing short-term analysis is that the highest time frame, or rather the time frames that we are going to use, are going to slightly change. Let's just do this. This is a very poor version of a table, or let's just do it properly. Yo, poor line there. Let's try and draw some straight lines there. Guys, you know that they say if you can draw a straight line, you're crazy. But nonetheless, that's not the point of today. Long-term, short-term. So we're going to define these time frames. You're saying for our long-term, we're using the daily, we're using the 4 hour. There's no point in us dropping down onto a lower time frame because it's the weekend anyway. The markets are even closed for that matter. So there's no point in us dropping down onto that lower time frame. Now we're going to say for ourselves, for our short-term analysis, most important thing that we need is that we need a reference. What the hell did we look at on the weekend? What did we look at over the weekend for our long-term perspective? We need that reference. So the only difference is now that on our short-term perspective, our middle time frame has now become the time frame that we use for our directional bias. Now we have a common time frame, and I'm sure you guys have seen it, that even on Monday to Friday, or Monday to Thursday, whenever you do the morning analysis, that one time frame that you will find both on weekend and both on during the week is that 4 hour. So what does that mean to me? That automatically tells me that to me, my 4 hour is my most important time frame. My 4 hour is the time frame that I want most of my decisions to be off, because it is the time frame that I'm looking at most of the time. It is the time frame that I'm giving most of my market time. Most of the time when I'm looking at the market, I'm looking at the market at from a 4 hourly perspective. So by default, automatically, indirectly, I understand what's happening on the 4 hour more than I understand any other time frame, because I look at that 4 hour more than anything else. So the 4 hour now becomes my important time frame, my key time frame that I'm trying to make most of my decisions off. So nonetheless, my 4 hour now becomes a time frame where I am looking for a directional bias. So still everything remains the same. 4 hour directional bias. Obviously, one time frame lower than that maybe is the H1. So 1 hour maybe would be used for our middle time frame to find those points of interest. And then for me, 15 minute, 5 minute, 1 minute, doesn't matter. But for me, any time frame lower than the 1 hour is an entry time frame for me. Obviously, I've defined those time frames to specifically 15, 5, and 1. So only those 3 time frames will function as entry time frames for me. So I don't go in between like a 7 minute or like a 30-minute time frame, or whatever the case is. I've defined those time frames because the point of creating this process is to define what you're doing, so that when you're doing it, you're not thinking about what you're doing in the process. You've already got a process that has done the thinking for you. Now you can think about other things. Think about how to manage this dude that's about to execute the process. Your focus is somewhere else now. So nonetheless, H1, and then obviously those 15-minute time frames. And now each of those time frames has now been defined. When I'm trading during the week, I know that when I'm on the 4 hour, the only function the 4 hour has to me is for me to find a directional bias. When I'm on the 1 hour, the only function the 1 hour has to me is to find a point of interest on where I can be able to buy whatever directional bias I found from a 4 hour, that point of interest. What's the lower time frame? The lower time frame is where now in this point of interest, I'm going to look for my chart patterns, where the price is breaking below structure, breaking back above, retesting and continuing to the upside. Doesn't matter. I've got my entry criteria that I've defined, that I'm 100% well aware of how I'm going to be trading. And so now you guys can see that my whole process is kind of so similar. It's so chilled that analysis is 100% chilled. I know that I'm going on these time frames. There's no point in me going to give myself high blood pressure, going onto my entry time frame when price is so far from my point of interest. Now I'm jumping into trades unnecessarily. I'm doing this, I'm doing that, giving myself intentionally high blood because I never defined and said to myself that there's no point in me dropping down onto my lower time frame if price is not within an area where I want to trade. Just adding that rule, indirectly, now there's discipline, now there's this, now there's that, now there's that. But nonetheless, we've defined our whole process of analysis. After now our process of analysis, we've said we need to forecast this market. So for our now process of our forecast, guys, from here, our process of analysis is the most lengthy part of us defining, because when we're defining how we're going to analyze the market, remember that once you turn this English into pictures, it then becomes your go-to setups. You now have a setup for your entry criteria. You have a setup for how you trade double bottoms, how you trade descending structures, how you trade ascending structures, how you trade inverse structures, how you trade off a trend line, how you even draw your trend line. Once you turn it into a picture, you now have a setup. And that setup is the thing that allows you to make sense of what's going on the chart. That setup is what makes the difference between someone saying, I see a head and shoulders versus someone saying, I see a triple top formation, because we all know they all have 3 tops, but how those 3 tops are formed are different. That picture, that setup that you've said, this is how it looks to me. If the words, if whatever the English says, but this is how I define it as this is how it makes sense to me. This is how that is now the setup. So guys, please turn the English into pictures so that you can get your setups, so you know exactly definitively what you're looking for. Nonetheless, your process of forecasting only involves 2 things. First of all, forecasting involves knowing which direction you want to trade. After you know which direction you want to trade, forecasting involves knowing where you want to find that trade. Have we not defined that in our analysis? Now we know that if we're forecasting on the weekend, which two time frames do we use to forecast off? We use the daily and the 4 hour. Those two, by just doing the process of analysis, we've already got a directional bias and a point of interest. So for our forecast, all we need to do is we need to draw lines. That's simple. We've got our setup, or whatever the case is, prices here. For our forecast, all we need to say is, this is our point of interest. This is the direction we're looking to trade. Done. That's us forecasting on the weekend. If we're forecasting during the week, all that's changed is now changed. All that's changed is now just the time frames that we're trading. Now, our forecast involves a directional bias from our 4 hour structure and a point of interest from our 1 hour structure. And you can see that even that shift in the forecast, just by defining long-term perspective and short-term perspective, that change in your forecast has already helped you be more up to date with what's going to happen right now. You're no longer functioning off a forecast from the weekend. You're now functioning off a forecast based off the price action that is happening today, because now your forecast, the directional bias and the point of interest that your forecast is coming from lower timeframes that are closer to, or more relevant to the decision that you are going to make. So nonetheless, we've defined your process of forecasting already. Just all you need is your directional bias and a point of interest. That's done and dusted. Now, after we've forecasted the market, now we're getting to the interesting part, the part that a lot of people struggle with, but it's the part that we've already just defined, and we've even put it in black and white. Black and white, like a lawyer can go and review our trading process and say that we've already done our entries in and out. Nonetheless, we're going to enter the market. So we need to speak about our entries. Now, what do our entries involve? First of all, just by looking, our entries involve what's happening on our lower time frame. So we can already conclude that, I spelled entries wrong. We can already conclude that anything that we're going to have here as our entry criteria should have already mostly been defined by whatever we've done by defining what we're looking for on our lowest time frame. Because what is the function of our lowest time frame? It's for the purpose of entries. Now, the things that we've defined on our lowest time frame is the chart patterns that we're going to trade. So now we are being specific as to say that for the entries, this is not us just being redundant and copying and pasting our lower time frame analysis process as our entry process, because the same things that we use to look and make sense of the information, which is our process of analysis, looking and making sense of the information, is the exact same pieces of information that you're going to use to press buy and sell. Is that information not required for your next decision-making process for you to press buy and sell? 110%, yes, it is. So that means everything that you're looking at for on your lowest time frame is now your entry process. When someone says, what is your entry criteria, or what is your entry setup? For example, someone has to ask me that. Simple enough, I look for chart patterns. Once the chart pattern has showed me where I look for candlestick confirmations, the next best thing for me to do is now just define what candlestick confirmations am I looking for. Only 2 candlestick confirmations I'm looking for is rejections and momentum shift away. That's all I'm looking for in my candlestick confirmation: rejection and momentum shift away. Remember, once you turn this English, because the English is just there for me to communicate this to you. Once you turn the English into a picture, then you've got a setup. Then you've got something that you're objectively looking for on a chart. What defines a rejection for me? A pin defines a rejection for me. What defines a rejection for me? I mean, a momentum shift away for me. A bearish engulfing defines a momentum shift away for me. Now you see that I've got English that obviously helps me find and make sense of what I'm doing. But obviously, once I turn this English into a picture, now I have exactly definitively what I'm looking for. And I can even tell someone else what's my process. It's very weird, and I'm not calling anyone out, but a lot of the times I do have, and honestly, I do understand, because I've been through that process as well. So I'm not calling you out, and I'm not saying it's a bad thing to go through this process. It's a process that everyone goes through, where maybe I'll ask someone, what is your entry process? What is your entry criteria? And maybe someone would just say to me, I trade a break and a retest. Is that definitive enough, guys? Is trading a break and a retest honestly your whole process? And I know that it's not. I know that there are more things, but maybe they're just not coming to mind when I asked you the question. And this is, I'm not being specific to anyone. I'm saying, I'm generalizing, guys. I'm generalizing. But when someone asks you a question like, what is your entry process? And your response is something like, I trade break and retest. All that should tell you is that, my man, my lady, I have not defined what I look for to enter the market enough to even begin to start saying I'm entering the market. I haven't defined it enough. If I can't explain to someone what is the process that I use to enter the market, or I can't objectively show someone what is the structures or the things that I look for. And the structures and the things that I look for are defined by me. I say that this is a pin bar. I say that this is a bearish engulfing, because some people define a bearish engulfing by prices having a lower low than the previous low and a lower close than the previous low, which is my rules for bearish engulfing. But other people just look for prices to close below the previous close, and that is a momentum shift for them. So even defining that simple thing can be the difference between you taking crappy entries and you taking good entries. That's how deep I mean define what you're doing. If you're going to do it, know the English about why you're going to do it, be able to explain it to someone, and don't have it as something that, oh, I'm just looking on the charts for this. I'm just looking. If you've never put it down into English, you haven't defined it enough. Point being. So nonetheless, all I'm looking for is rejections and momentum shift away from a level of structure. And that is my candlestick confirmation, which my chart pattern on my entry time frame is going to tell me where to look for. All I'm looking for is pins and engulfing candlesticks, whether it's to the upside or to the downside. That's how that's kind of how simple I'm trying to make it. I'm trying to cut out as much unnecessary dilly-dallying as possible and just try and make the process very simple, that rejections, momentum shift away. Even your tweezer, people would call this a tweezer top. See how the English will catch you. See how the English will catch you. Someone will say that I'm looking for a tweezer top. How often are you going to find maybe something called a tweezer top? But if you're looking for a rejection, oh, wow, beautiful. We see two rejections from, oh, momentum shift away. Oh, beautiful. And the guys, now you've defined, no matter how the market is going to show you rejections and momentum shifts, because you've defined it, now you know how to look for it. No matter how the market, whether the market is going to show it in the form of a tweezer top, whether it's going to be a morning star, whether it's going to be just the one straight bearish engulfing, it's all the same thing when it comes down to the English, that price is rejecting from a level of structure and then showing you momentum shift away. And so defining it down to that point simplifies the process so much more. So now, after we've basically defined now, what are we using or how do we actually enter the market? The next part of what we need to define that we spoke about is now our position management. Let's just position and then management. So our position management obviously now comes down to how do we manage this position when the trade is open? Now, managing our position comes down to two things. First of all, how we're going to set our stops, how we're going to adjust our stops, how we're going to set our TPs, and how we're going to adjust our TPs. Done and dusted. This is our process of position management. Only involves two things: how we're going to set stop losses, how we're going to adjust stop losses, how we're going to set take profits, how we're going to adjust take profits. Now you can define it in English for yourself. So you can say that for my stop losses, I place my stop losses above structure, or let's just say I protect my stop loss using structure on my entry time frame. Done. And this is you defining how you set your stop loss. I protect my stop loss by setting it above structure on my entry time frame. Now, obviously, when you turn that into a picture, no matter what, remember that on your smallest time frame, you're looking for a chart pattern. Even if that chart pattern is a double top structure, there are two places where you could enter double top, either at the second peak or the break and the retest. Nonetheless, you enter at the peak. Where's your stop loss? Above structure. What time frame is this? This is your entry time frame. You enter at the second peak or the neckline. Where's your stop loss? Above structure. Why? Because this is your entry time frame. Already, by defining the chart patterns you're looking for on your entry time frame and how you find points of interest on your entry time frame, those have also given you, those have also given you how a way to minimize risk using that entry time frame. Because remember, your entry time frame is solely for the function, for the purpose of jumping into that trade with the smallest risk possible, obviously still targeting your higher time frame rewards. So nonetheless, you've got points of interest on how you're going to set your stop loss. You're going to always protect your stop loss using structure on your entry time frame. Simple as that. Or you could say you're going to protect your stop loss using structure on your middle time frame, or however it be. Whatever makes your system a profitable system, that's how you're going to define and say, this is my process. I'm always going to know, even if I enter on a 5 minute, when I'm setting my stop loss, I'm going to set my stop loss above 1 hour structure, because that's my point of interest time frame structure. When I'm setting my take profit, I'm going to set my take profit based at my next point of interest. How do I find my point of interest? On my 1 hour time frame. So it means that on my 1 hour time frame, once I've found a place, maybe on my 1 hour, I've got how can we use a different structure? There's only a limited amount of structures. Let's use a continuation structure. Let's just say that this is our bearish flag, or let's just do it a bit more like this. This is our bearish flag. Cool. We've got our break above structure, whatever the case is. Now we're looking for our downside. This is, let's just say, our 1 hour time frame. Now on our 1 hour time frame, we're looking for points of interest. So because we want to sell, because we're expecting a bearish flag, we've got resistance over here. And obviously, where's our most extreme support is down here. So nonetheless, we've got extreme support and extreme resistance. Now, obviously, when prices break below our structure, on our lowest time frame, which is maybe our 5 minute or our 1 minute or whatever the case is, we're going to find something that gives us an opportunity to enter this trade, whether it's an ascending structure, whether it's a double top, whether it's a what, doesn't matter. Whatever criteria chart patterns we're looking for, that's what we're looking for at our point of interest. Now say we find candlestick confirmation in this area here. Maybe we're protecting our stop loss using the structure. So target there, above there, entry over here. And obviously, where do we want to exit, or how are we setting our take profit? Point of interest. How do we find points of interest? 1 hour time frame. Where's our extreme support? Down at this area here. So now we know stop loss above structure, TP down here. And this is something that we can follow, and we can follow, and we can follow, and we can follow. And there's no room for us to say, I think, I guess, I whatever, because everything is objective on the chart. We've defined it already on the time frames just by our process of analysis. So nonetheless, now, in terms of our adjusting stop loss, obviously we don't adjust TP. In terms of adjusting TP, what you could do is set multiple take profit areas, obviously where you look to exit at every point of interest. Maybe you've got your extreme support, but any other point of interest where price can react, that's an area where you could set a secondary TP or whatever the case is. In terms of adjusting your stop loss, simple enough, you could either adjust your stop loss trailing according to structure, above swing highs. I mean, I'm making a case for sells. Obviously, maybe if you're buying, then below swing lows. And how you could turn this into English, I'm just showing you the picture. How you could turn this into English is now you're defining how you adjust your stop loss. For me to adjust the stop loss, I need to wait for market to create a low, create a high. And once market closes below this low on my entry time frame or on my middle time frame, or whatever the case is, you're defining, not guessing, we're defining on my entry time frame, then I will trail my stop loss above the swing high. Once price creates a new low, creates a new high, and closes below this next low, then I trail stop losses above the swing high. Same thing, obviously, if you're buying, prices create a high, create a swing low. Once prices close above the swing high, then you trail below the swing low. Same thing, rinse, repeat. That's a way that you could obviously objectively define how you're going to manage your positions. Now, after we've managed our position, I see we've got like about 8 minutes left, so I'm going to try and be as fast as possible. So after we've now managed our position, obviously we said that our entries and exits, we're going to split them up. So after that, we obviously exit our position. And you guys can see that by defining how we're going to manage this trade, because part of managing this trade is setting how we want to exit, how we want to how we want to manage as it moves. We've already defined how we're going to set our stop loss. So you guys have already defined your exit criteria. Whether you said that for your stop loss, you're going to use your entry time frame and you're going to use your structure on your entry time frame, whatever the case you've defined as how you're going to set your stop loss for your position management, that is literally your exit criteria already defined. So now after we exit the market, obviously we said that there's one thing that we should have taken into account, I guess, before anything else, and that is our risk management. Now, obviously for our risk management entails us, or for us to properly suck out the most that we can suck out from risk management, we already need to understand some statistics about how we trade, because part of risk management is understanding what your win rate is of how you're trading. And also, once you have a win rate, the next most important thing is setting a nice risk to reward ratio that will obviously make you profitable. Simple enough example, guys. If maybe you win, okay, let's do this. We create a structure. We'll say that whoever's at the low end of the spectrum has a low win rate. Whoever's at the high win rate end of the spectrum is going to be up here. And this is kind of the middle. So we're going to say that if your strategy has less than 50% win rate, that you lose about half of the trades that you take, or more than half of the trades that you take. So if you win maybe one trade, if you win maybe two trades, if you win maybe three trades, if you win maybe four trades, then you need to have a system that has a high risk to reward ratio. Your risk to reward ratio needs to be higher the less that your trade, or the less that your system wins. Obviously, the more your system wins, obviously the easier it is to have a long-term profitable system with a lower risk to reward ratio. So for example, let's just make a quick example. You've heard these guys, Uncle Order Blocks. And I hope I hope Alpha's in this session. I'm trying to tease Alpha indirectly here. Uncle Order Block. Uncle Order Block, maybe for example, he trades, or anyone that trades order blocks. Let me not be specific, because that's not my intention. I'm not trying to be specific. I'm trying to drive a point. Nonetheless, let's just be specific with this example and say that someone that trades order blocks, for them to be 100% effective, they need to trade every single order block that develops for them to actually find a trade that gives them, I'm sure you've heard of people taking 1:30, 1:to whatever, ridiculous RRs. So obviously you need to trade every single order block for you to find that one trade that does give you that ridiculous RR, which means that your trading system has a low win rate, which means that you lose a lot of trades before you find that one that hits your home run. In that case, that high RR makes a lot of sense, because that high RR over a long period of time, maybe you've lost 10 trades and your 11th trade gives you a RR of 1:18. That means you're still up 8%, even though you've lost 10 trades. Now, for example, if you have a high win rate and maybe you're trading structures, and out of every 10 trades, you win, let's just say you win about 7 out of every 10 that you take, and you lose 3. You can literally trade with a 1:1 risk to reward ratio and still be profitable. Why? Because out of every 10 trades that you're taking, you're making 7% and you're losing 3%. It still gives you a net of 4%. So you're still up, even if you're trading with a risk to reward ratio of 1:1. So simple enough, you obviously, first of all, to define your risk management, and a lot of, like, especially to define your RR, guys, please don't function off this thing of 1:3 minimum risk to reward ratio, 1:to whatever, 1:to whatever, because yes, there are guidelines, but we can't objectively tell you. The honest truth is that no one can tell you what RR is going to make you profitable. It all depends on how often, or what is the win rate of your system. If your system loses more, have a higher risk to reward ratio. If your system wins more, you can have a lower risk to reward ratio and still be profitable. Done and dusted with risk management, and basically this element of risk management. Obviously, final part of risk management comes down to now you defining your specific risk as to how much do you want to risk per trade and all of those nice good stuff. And that obviously boils down to the capital that you have. Now, what I'd like to do is, obviously, if you have a capital, let's just do this. If you have a capital that is less than $200, do this for yourself and divide $200 by maybe something like 60, say 200 divided by 60. And what this means is that whatever your answer is, or if your account balance is less than $200, divide it by 60. And whatever your outcome is, let's just say you divided your account balance by 60 and you came up with 3.3. Let's just say for some weird reason you got 3.3. Now, what this means is that for every trade you're going to take, you're going to risk $3.03. Now, how you're going to do this is obviously by calculating your risk, your lot size, ensuring that within your stop loss, you're risking $3.30. But what you're doing for yourself is you're saying that no matter what my account balance is, no matter what my capital is, it's going to take me 60 trades. It's going to take me to lose 60 positions in a row to blow my whole account. Because whatever my account balance divided by 60 is this amount, that means that if every trade I risk this amount, it will take me 60 trades to blow my account. So what you want to do, remember that your primary function is to preserve capital. You want to be here to trade tomorrow. Gambling don't work here, guys. You make a lot of money today, it disappears a month later or 2 months later, and you won't even see where it went. The market will just drink it now. Gone, done and dusted. So what you want to do is focus on your risk management. How can you preserve capital and stay long in the game? So in terms of how much you want to risk, maybe if you can't function off percentages like risk 1 or 2% of your account, then use this system and ask yourself, how many trades will I have to lose in a row to be able to blow my account? Guys, please have it over 50 because that's you playing safe. If you're going to say, I want to blow my account within the next 20 trades, that's not giving yourself enough leg room. That's not exercising. That's not approaching the market with the mindset of being here tomorrow. Definitely not. So try and have a good sample size that you're going to say that it's impossible for me to lose 60 trades in a row. So that's kind of how much I want to lose for me to be down and out on this trade. Guys, we have 1 minute left. We're not going to start another session. So let me just conclude by saying that part of the disciplines that, remember that our last section was disciplines. Part of the disciplines that you can add for yourself are things like journaling, holding yourself accountable to journaling maybe every week, maybe every single day, whatever the case is. Doing things like advanced self-review, where you review your processes. Doing things like going back to review how well you executed your process. Those are disciplines that you're going to hold yourself accountable to. And those disciplines will obviously reinforce how well you execute your process. I think I'm done. I don't want to be rudely cut off by Zoom. So let me just call it a session right here that we're still here with each other. Let me say, let there be peace. It has been an interesting session. I really hope that you guys were writing down and doing things on your